All right, let's begin our class. This is the last session. For those of you who's going to take entrepreneurship for next semester, entrepreneurship starting on September 14th, okay, instead of on August 31st. It was scheduled on August 31st by school. However, I thought it is not a good idea because that is the day on the long weekend, Labor Day long weekend. So I think definitely it's not a good idea for those of you, including myself, to start our new session on the long weekend. So I proposed and also I changed that. So do not come on August 31st. And for those of you, you are watching this video, for those of you who are watching on this video, and also please pay attention. This is probably the most important message from this video. Okay, do not come on August 31st. Don't come. There is no class on the entrepreneurship on the, August 31st. Instead of, we change that the first class to September 14th. And also for those students, you complete everything, you graduate from this program, I just wish you the best luck and also wish you the best career in the future. Right? So we are going to talk about two issues today, right? To complete our discussion cover under this financial accounting. The first one is liability, and the second one is ratio. Okay, so let's get a little bit review about the liability. So before I show you the slide, okay, before I show you the next slide, can everybody think about one item, at least one item in your mind, to as an example, okay, as one example under the liability. So when we talk about liability for the financial accounting purposes, what could be the example in your mind? So think about this, then give me your answer. I think should be a lot, but at least just give me one. Each of you, give me one example. Then I will turn to next page. So let's start with the discussion from this refreshment. Yes. Okay, anything payable. So say for example, accounts payable. Okay, what else? Note payable. We'll talk about note payable. And stop for a while. Okay, and we talked about this before, but let's get refresh. Okay. What is the major difference between account payable and note payable? So when we differentiate, some item is note payable, some items is account payable. What is the major difference between those two accounts? Short term. Which one is short term? I know. Which one is short term? No, which one? I mean, note payable, account payable, which one is shorter?
I think a note is shorter. Is it? No?
Accounts payable is shorter. Okay? Around 30 days. This is what I mean, short, okay, short term. And give me example, what kind of item could be classified as account payable instead of note payable? What kind of item could be classified as account payable and not note payable? For example, we know account payable is short term. So give me example.
Electrical bill.
Could be, yeah, PG&E bill, because you pay each cycle probably within 30 days. Could be.
Vendors bill from vendors.
Yes, you purchased the inventory. You purchase, but the inventory is not the only one, right? Anything the cycle, the payment cycle around or within 30 days. So like PG&E, like rent payable, for example, rent payable, Okay. The reason why we don't use rent payable, because usually we pay rent in advance, right? so rent excuse me, so rent payable is not that common. Rent payable is not that common, but if you enter into very unique and favorable lease agreement, you can pay by the end of the month, then you need to enter into rent payable on the first day of each month. But that's not very common, so we can disregard it. So any item, the payment cycle is shorter than 30 days or around 30 days, we say this is a current one or this is a short-term one. We'll see, this is important, okay? Current liability means something you need to pay in short term. And there is no definite definition. There is no definite definition about the current, but it's about 30 to 60 days. And very regularly, you pay off those accounts around 30 to 60 days. And we classify those items as a current liability, mean short term. And that is important. Okay, that is important. Why? Because in order to establish your payment, you need to excuse me, you need to keep, okay? You need to keep cash or current assets to fulfill your current liability. We will see what are current liability, very short. But at this moment we know we have a current one, we have a long-term one. So long-term one usually is note. 1 year, 2 years, 3 years, even 5 years, 10 years. Okay? So anything following by payable, we know that is very typical liability. But other than this, something payable, other than this, anything in your mind that is definitely liability.
About the product warranty.
Very good. Product warranty. Warranty item. Say for example, in the computer business, okay? 3 months, even 1 year is kind of an industrial standard, right? If you are manufacturer, even you are retailer, okay? And it is very common industrial standard, you provide 3 months warranty, 6 months, sometimes up to 1 year. So when your company offer warranty and this warranty become liability, so again, for your final presentation, okay, you'll be due in a week, okay? So hopefully you complete already. If you're not yet, warranty is good issue. Warranty, it is good issue. Warranty is one type of liability. We don't have time to talk about the detail, but it is very good topic for you to do the research. Anything like kind warranty, similar to the warranty, like some promise, okay, something like that. So for example, when your company provide a 1 year warranty, so when you make the sales, of course, you enter into revenue, no doubt. Say $1,000 sales, right? That is the separate issue we discussed a few weeks ago when we talk about sales. However, in the meantime, you need to reserve certain amount of money into the reserve. Okay? Reserve is kind of assets. However, to match this reserve, you need to create some kind of liability account. And again, we don't have too much time to talk about warranty issue, but it is a very good topic for your individual to do the research as your final presentation. So warranty, okay, could be the liability. Okay, could be the liability. What else? How about judgment against? How about a judgment a judgment against your business. Say for example, out from any dispute, and that dispute went to the litigation, and finally there is a judgment entered by the court, and which is against your company. Say 50,000, 10,000 plus interest, and you have not paid for it yet. Okay? However, if there were a judgment against your business, that judgment become one type of liability. Okay? Even though you have not paid cash yet, but that may become, it's not may, okay? It is one type of liability against your business. One more thing, I will move on. I just want to remind you there's one very important item. Don't overlook. We talked about that before. It is not new one. When you see this item, you must be very, very alert, and don't put that into the wrong box. There's one item we talk about that even from since the first class, the first session. I say be careful when you see this item. Don't be fooled. Don't be misled. And be careful. That is unearned revenue. That is prepaid or unearned. It's the same thing. Somebody prepaid to you, okay? So you receive that as cash. So you deposit already. So cash you already debit into your cash account already, but don't put this as revenue. Don't put this as revenue. Anything somebody prepaid to you or from your standpoint is called unearned revenue. It is not real revenue, okay? Anything prepaid to you or anything labored as unearned revenue, you need to put that as liability, okay? So having said that, let's move on. Let's have a review about the item under the liability, okay? So this is a liability chart, okay? Welcome back. How was the trip? Is this not too bad? Really appreciate it. From Chicago, right?
Yes.
Really, really appreciate it. We have a very, very long distance commute. Really appreciate coming back, every other or every Friday night and coming here for this class. Okay, this is one example on your page 460. 460. This is one example from the Starbucks. And this is a real one, okay? This is a real one. So this is not really updated, but this is a real one. 2005, 2006. And we all know Starbucks experience is up and down. You heard about the news, right? And it was very good, but during this period, I think this is a very downside. Because the previous CEO left, and for a few years, Starbucks experienced very, very bad sales. And then he went back to took over the CEO position again in the company after this period and just came back, right? So I think during this period probably it was is downside. And we can see, for example, we have everything payable here. Say account payable, accrued compensation, accrued occupancy. Anything accrued here means you have not paid yet. Anything you not paid yet. So could be very short term. Yeah, remember when I said current one means you are supposed to pay within around 30 days. So everything accrued here, like PG&E, like accrued salary, compensation, anything you are supposed to pay off within or around 30 days. So we have accrued tax, right? Taxes, okay? We have a short-term borrowing. We have other accrued expenses. So probably PG&E is here. Utility bill is probably here. Deferred revenue here, right? That's what I mean. Deferred revenue. So under the different title, different terminology, it means unearned. It means unearned. Somebody prepay to you. Okay? We don't say prepay, okay? Because prepay usually means you pay us to somebody else. So we don't use prepay. We either use deferred or unearned. So to differentiate which side pay up. So here you know you receive, right? You are recipient. Current position. Okay. So total current liability. Everything here, I believe, 1.935. I just assume this 1.9. This is $1 is $1 billion. This is my assumption, okay? All right. For this kind of company, we don't say million, okay? We say billion, okay? It's starting from B, okay? So in the future, you say this is a B class business, okay? You know everything. The first letter stands for the billion, and for the small business, the first number usually designated as $1 million. So this is a B class, and this is an M class. And of course, there is no T class yet, okay? T is a trillion. Usually this government, only government, use a trillion. For business, usually billion is good enough. But of course, for small business, this is another T, right? This is 1,000. Right? So it's not really the trillion. But another small letter T, this is 1,000. So the number one is $1,000. There was nothing wrong, Any business start from a small business. Okay, so we have current liability, 1.9 billion. Okay, and then the other one we have long-term debt. So you can see what is the structure here. What is the structure here? For any kind business, doesn't matter what kind of industry you are in, usually short-term or current liability is much bigger than your long-term. You got a point? It's almost 1,000. This is almost 2,000, 1,000, right? This is 1,000 times for this business. You see, the current one is 1.9 billion, and the long-term one is 1.9 million. So this kind of ratio probably it is industrial standard. It makes sense. It makes sense. If anybody gonna lend money to you, usually 1 out of the 10 only give you long term. Is that true? Right. 9 out of the 10 they expect you to pay back within the short term. So that makes sense. So that's why the current one is so important.
What usually do here is the other long-term activities.
We'll see it. We'll see what is the long term. Long term means more than 60 days. Say 1 year, 3 years, we'll see that. We'll see that. Usually you have the long term finance for your equipment. Got it? You need to get a mortgage, for example, to acquire your factory, right? For your office. That's the long term. Usually this is 30 years. And you need to lease a truck, say for example 5 years. And you want to lease a copy machine, for example, right? 3 years probably, right? So usually we use the long term to finance your equipment or fixed assets. We talked about fixed assets a few weeks ago, right? So, and then fixed assets except land, okay? Except land. Almost all of fixed assets except land subject to depreciation. We talked about that, right? Remember that, right? So the rule of thumb, not necessary, but not absolute, okay? But usually the rule of thumb is we use long term to finance your fixed assets. We use short term to finance your suppliers, okay? Your inventory, your daily operation, like a utility. All right. So this is the way you can easily differentiate what is long-term for and what is short-term. Got it? We will see more example. And this is not easy, okay? This is not easy. I hope I will not get you confused. I try to, start with an easy way. And when we get into the long term, it's not easy, okay? The reason why the long term it is and the more complex it is because when we get into the long-term finance, long-term liability, there is one more factor kick in. That is time value. If you only say pay off 1,000 within 30 days, the interest is not really a big issue, right? However, we talk about 1,000 in 3 years, the lender will not ask you pay just for 1,000. You need to pay for interest. So for the short-term liability, we can almost disregard the interest issue. At the most, we talk about discount. A few weeks ago, we talked about discount, right? But if you don't want to take a discount, at the most, you don't pay interest for the current one, right? You just pay it off according to the agreement. However, when we talk about the long-term one, year, 2 years, 3 years, 5 years, 10 years, another issue come in. That's the interest. If there is no interest, we need to calculate the time value. Is also called present value. Have you taken your finance year? Yeah, from your finance course, we need to calculate. We need to take into account the time value, the present value issue. We'll talk about that. So that issue makes the whole thing more complicated. So I hope I will not, get you lost, But that is the issue we'll talk about. All right. And then we need to talk about this current liability, we just mentioned, okay? We have a current one, we have a long-term one, we have present value. Very soon we'll talk about that.
Okay.
And there's one very important ratio before we go into the chapter 14. That is a current ratio. Very important formula. That is a current assets divided by current liability. Current assets mean cash, okay, or any other assets. You can convert it into cash easily and quickly. Usually say within 30 days, even shorter. So for example, government bond, if you can freely liquidate your inventory, okay, your account receivable, you're pretty much sure you can receive it within a short term, all right, or any other short term stock you invest in somebody else, and from the open market you can liquidate the stock easily. That is called current assets. So the whole ratio is current assets divided by current liability. And you know what? You're better off seeing this number greater than at least 1. At least 1. And not necessary, okay, by the way, not necessarily greater is better. No, not necessarily. Not necessarily, okay? You need to get a balance, all right? If you have this ratio too large, remember I said not necessarily bigger is better, right? If you maintain this between 1 or 2, that's fine. See this one? Starbucks 1.81, nice. 2005, a little bit shaky. 0.99. You don't want to see your borrow. If Starbucks is your borrow, you feel scary. Okay? Any company owe you money and this ratio drop under 1, freak you out. Okay? Of course, Starbucks is a good company. They will not go default. We believe. However, for any other company, when you see this number below than 1, really you must get alert. And 2006 is even lower. Okay? So you maintain between 1 and 2, that's fine. Say another company, Peace Coffee, more conservative, 2.57, but for another one is a 2.98. So around 1 is okay, alright? So can anybody tell me 2.57 versus 0.98? What is the message sent to you? Compare Peace Coffee and another. I never saw this one. Have you saw this one? Caribou, but probably not in California. But compare Peace Coffee 2.57 2006 to Starbucks 2006 0.71. What is the message telling us? One company maintain current ratio so high, 2.5. That really means each dollar current liability is backed out by $2.5 standing by. That is good, right? That is very good from the standpoint of the lender. But probably that's bad. Probably that's bad from the standpoint of the investor of Peace Coffee. Why? Why that is bad? So this is why I say not necessarily the ratio number greater is better. Why?
So
If you want investor of Peace Coffee, you may not have it. Why?
we
Keep
take it
too much cash and does not
Maybe.
wait to invest.
Maybe you keep too much assets
Yes.
idly there. You know what? The assets, I will come back to you, okay? You know what? The assets, from the standpoint of operation, should be utilized as a profit generator, not as a debt guarantor. You got my point? For the assets under your business, okay, the main purpose of the assets is to generate the maximum profit or create more potential opportunity for your business. Only secondary purpose is as a supporting resource to fulfill your liability. You need to balance those two conflict goals. It's kind of conflict because if you use $1 to fulfill your liability, you cannot use $1 to generate your maximum profit. So those two goals may sometimes conflict to each other. So usually if you maintain 1 is good enough. That is good enough. Okay? Instead of keep 2.5, Peace Coffee can reduce a little bit to use the assets as something else. Investment, R&D, to set up the new facility, to open up the new franchise. Take an example, right? Because when you open up the new franchise, you move from current assets to long-term assets, right? You reduce the amount from your current one to the long-term one. So you need to get a balance, all right? So I hope I give you the points. Any other comment? I believe I covered it, right? So not necessarily 2.57 is better than 1. Not necessarily, okay? But something like 2.79, that's a little bit shaky. Right? You know what does 0.79 mean? Each $1 liability you need to pay within 30 days, you only keep 79 cents. You only keep only 79 cents on your balance sheet. You understand? So unless you can improve this situation, otherwise on the due date, you don't have the money to pay. Right? That is the message. So if you are the lender of the Starbucks cafe in the year of 2006, you really feel so scary. You're sitting there and you pray, right? You're sitting there, you pray. You just pray the money come in, but hopefully, they can manage it. I don't know how, but they can manage it. They can pay off $1 with 79 cents. They just can make the magic. All right. Any other comments so far? This is called current ratio. Okay. This is called current ratio. Ideally, you maintain around 1. And more than 2, I think is kind of waste.
But I think for their 0.79 case, yeah, maybe for the current liability, maybe the company may not need to fulfill 100%, right? Maybe, for example, in some tax, later on government will credit some tax back. That's why they
Yeah.
0.79.
Yes, very good point. Okay. I just say, I think, Starbucks never default. At least I never heard about that news, right? So I know somehow, some way, they managed to pay off $1 with 79 cents. So you're right. So probably they have they were in some position, a big chunk of money coming in, or whatsoever. This is a grant or something else. But I don't believe this grant from to Starbucks Cafe. This is not high tech. So I believe this must be something. Okay? Because Starbucks Cafe. By the way, for those of you who are going to take my entrepreneurship, it is very, very interesting one, okay? Because we will have less talk, we will have more presentation. And then very soon, for those of you, you need to discuss the business model. It's very interesting, okay? And then at least we know Starbucks Cafe business model is consumer market. I cannot predict the government market, right? So I just cannot predict that they can get the grant from government. So they relied on the market change. They relied on more franchise open. And as far as I know, each store opened up by Starbucks is all 100% corporate owned. They don't have franchise. They don't sell franchise. Okay? So it's a very, very unique business model. So we just use this one as an example. Okay? For those of you who are going to take my entrepreneurship, we will talk about what business model is. So you're right. So, but at least I think that's not really happened to Starbucks. So I really want to figure out how can they manage, pay $1 current one. Okay, this is not 1 year. This is not 2 years. Okay, they need to figure out any way to pay off $1 debt within 30 days with 79 cents, without grant, without something else. They need to manage. Yes, go ahead.
For the regular company, you say the current ratio is reasonable for 1 and 2. But for the company with the good business future that will grow up fast, they may not, the 1 and 2, below 1, maybe still reasonable. But what number is risky for those companies with the good business future? What number is risky, still risky?
You mean the number?
0.25 or 0.3 or 0.5?
I think 0.5 is very risky.
Even with the Starbucks?
Yes, because it's a retail business model. And your revenue, I would say 99% or 90% rely on the sales, rely on the real sales. Because there's no franchise. You cannot rely on the new people coming and say, I want to apply for your franchise, right? So you have current location already. You cannot make a magic say, okay, tomorrow I will have a magic from 1,000 to 2,000 location. This is impossible. You have your current location already, and you can calculate, you can predict each location can produce how much revenue every day, right? So and also there's no overnight change. So I just feel so risky on this 7.79. This is my opinion, because you rely on the cash sales and you rely on the real retail sales. And if there's no something really surprise really happen, I just cannot imagine how can you make it, $1 payment within 30 days with 79 cents. I just try to figure out. No, let him finish.
For the investors, I believe that many of the investors try to look for the bad and the good company from the ratio. If say the ratio is 0.7, for example, must have the other index to support the investor to looking for the good company.
You're right.
And also for the some other index to support the investor to identify those bad company. So other than the ratio, what other index can support?
Why not, right?
Yes.
So I need to put this way. This is only one ratio. Okay, so let me put this okay. From the standpoint of an investor, I think this number is good. If you are an investor,
but
you'll be happy.
We are looking for the
big picture.
Big
Big
picture.
picture.
Good.
Right.
business future.
Yeah, we'll talk about that. Yeah, hopefully we'll have time to spend on the chapter 14. Okay, chapter 14 is overall. There are more than 25 something.
Maybe we say the investor, if the invest the company with the ratio 1 and 2, you can expect the stock price will not have the grow up.
They're kind of stable.
Yes, kind of stable.
They're kind of
So most the investor, they want to look in for the gold in the garbage.
Right. That's correct. That's correct. So again, from the standpoint of investor, I don't think 0.79 is a bad number. Eventually it's a good number.
90.
Right, because it's a very good management. As long as your manager can fulfill your $1 bill with 79 cents, you make the magic. As an investor, I'm happy. I'm so happy. So if you are an investor, I would say you'll be very happy with this number. Lower is better eventually, as long as you don't get default. Okay, lower is better. However, from the standpoint of the lender, you may feel tricky. You may feel it. So this is my input. But again, this is a very good. This is a very good final presentation topic for you. How can business manage, the current ratio below 1? You can choose 2 or 3 company or different 2 or 3 industry to make a comparison. Say for example, I believe Starbucks can make very good management, right? So look, eventually from the standpoint of the investor, the number lower is better because that really indicate you got a very good management team. You can make it. Sorry about that. Yes, coming to you.
I just think is it possible company get a more long-term liability or increase equity and to increase asset too. So
It is another issue. Okay, it is another issue. How can we balance? Okay, how can we balance the ratio between liability and the equity? That is another issue. That is another ratio. Okay, to compare your company because we know the total assets, that is the number add on liability with your equity, right? So ideally, again, that's probably 1 to 1. You have total $2 assets, $1 from liability, and $1 from equity, right? So if you have the liability too high, say 2 to 1, so total $3, $2 from liability and $1 from equity. This company really shaky, right? Because when you have a lower equity, that really means nobody want to be responsible. And when the company just file bankruptcy, this is it. And the lender or the somebody else or the joint venture, if they put the money in, they say, okay, don't give me the equity. I don't want the stock. I just want to give me the note. It's more like impossible, right? When the joint venture come in, when the venture capital come in, they always ask for the stock, right? So there's another issue, but we don't have time to discuss.
Question: how do you calculate current assets?
Okay, current assets is the one. Let me see. I will give you the definition, but right now just give you the roughly idea. Okay, cash, inventory, account receivable, everything you can receive. You can receive the money. You can convert to cash in short term, and there's no really definite definition. So as long as you can convert it to cash, you say 10 days, 5 days. So I believe, so that really amazed me, because when we talk about 0.79, that really means you already include cash already, you include inventory already, you include the note or the short-term note receivable already. So how can you manage to convert something you cannot convert this, right? So this is amazing. This is amazing. So I think from the standpoint of the investor, that's good. That's super good, So as a very conservative, I would recommend say 1. But as long as this company even lower, even 0.5, you can make it is good. So answer your questions. Current asset, that means cash, okay, or the open market public stock. You can sell it right away, okay. You have a government bond, you can liquidate it without any penalty. And you have something like short-term account receivable or inventory, like that. You keep a lot of coffee in your shop. You can sell it right away. That's all included under the current asset. So very good discussion here. Okay. Okay, I would just want to give you one example. Okay, I don't want to get into too much because okay, how about this? Turnover. Turnover. Account payable turnover. Not very important. This is also you use this one to evaluate the management. Okay. Account payable, we know that is the liability. Okay. How many times you turn over in 1 year? Okay, that is the number. You have a cost of goods sold, total cost of goods sold for the whole year. Cost of goods sold, that number appear on your income statement. Okay, so you cannot see the cost of goods of this year because this year is not in yet, right? We can only find out the cost of goods sold from last year because this number appear on your last year income statement. And we all know income statement will be closed, right? We call this closed book. Once we finish this year, income statement is done. We don't follow out the income statement from last year. So when we try to find out what is the number of the cost of goods sold, no cost of goods sold of this year, remember, okay? We can only find out the cost of goods sold from last year. So cost of goods sold divided by average account payable, compare with the same year. Average means the beginning of the year, the end of the year, and divided by 2. That's one way to calculate. You can use so many more complicated, more advanced way to calculate what is average, okay? So for this company, the total cost of goods sold is 3.1 billion, I assume, okay? 3.1 B and divided by 280 million. So we see for this company, the comparable is 11.3, almost 12. That really means pay on time. You got a message? A comparable turnover means how many times you turn over your comparable one time, once. So this company pay almost 12 times, which means each month you pay off your total comparable. So from the standpoint of financial strength or your credibility, okay, indicate your credibility is very good. You maintain, because usually your cycle is 30 days, usually, right? You're almost on your circle. 11.3 is even shorter than 12. Even shorter than 12, right? Let me convert that. 11.3 means you pay more than 30 days one time. You pay more than 30 days because 12 means exactly you pay off 30 days each time. 11.3 means less than 12, so that means your each cycle is slightly more than 30 days, but still good. You still maintain very good credibility. That really means your payment pattern is very on time. So this number probably is important for you to evaluate your customer. If your customer apply for the 30 days payment term to your company, and this number indicate, well, this company is at least trustful and keep a very good pattern. So the number lower mean longer payment days, right? So if one company only turn over one time, that means only pay one time each year. I don't believe there is such company. Okay, I don't believe so. The next one we will see, we jump to note available. Okay, here. We need to look at three pages at the same time. Okay, one is on your book is a table of present value. This is in your appendix A. We need to look at this page. And also open out your index A-2. Right, so we need to keep those 2 pages. Okay, let's see example. Okay. The first example is your company go out to buy a machine, whatsoever, okay? A truck, okay, in this case, it's on your page 479. This is the note payable, alright? So we know interest issue coming in, or the present value coming in. So on a certain day, your company go out to buy a truck, and on the agreement, your company don't pay nothing. So sometimes the vendor, they provide promotion, say you come in to pick up your truck, and they even say zero. They even say zero interest, but it's not really true. Okay, they say you don't pay anything until the certain day. So in this case, your company doesn't pay anything, only pay off 2 years later. So you purchase on the January 1st on a certain day, you pay nothing, and on the agreement you need to pay total 200,000 cash on the last day of the second year. So you know there are 2-year period. So on the day your company pick out the truck without the concept of present value, probably we just enter into the assets debit 200,000 on the truck, and also we have a note payable 200,000 credit. That is the way we done it. However, we changed that. We changed that because the real value of the truck, it is not 200,000. Even though the vendor say zero interest, but we need to modify the numbers there. Okay, how do we do it? Everybody follow me so far, right? Everybody follow me so far, because right now 2 years, there is one major factor kicking in right now. That is called present value. So even though on the agreement we say we don't pay anything, but we will pay 200,000 cash all in one time 2 years after. However, on the first day, we receive the truck on our key account. We don't enter into 200,000 as the value of the truck, because that 200,000 was the value totally we're gonna pay off 2 years after. So that number eventually include the real value on the truck plus the time value as interest. So we need to calculate it. We need to separate. So that factor make the whole issue more complicated. Okay. So we have the factor here, 0.7972. And this number is from index here. It's 2 years. Okay. 12%. I did not highlight it. I will go slowly, okay, because I don't want you to get lost here. It's from this number, 12% here, 2 years. Okay. Because on the questions you mentioned, the market rate